So thank you for joining, everybody. We've got, hundreds of people from all over the place. I see, many countries represented, and we have a very distinguished group here, don't we? We've got, as a quick kind of intro, I don't know if you've had a chance to start introing yourself real quick. I will do the honors, and I will do a quick intro for everybody, because everybody here is a friend of mine, and I've had the pleasure of knowing you. So we'll just do a quick intro so we can dive into the meat, because I think that's why everyone's here. We want to demystify the process of fundraising, and particularly in the 2023 landscape. So Antonia, great to have you. Ladies first, so good to have you on here.
Great to be here, Brian. So should I introduce, should I start the intros then, or should you introduce?
I'll just do a quick intro of you. I know your story. You've been an investor. I think you were one of the youngest GPs is the word I get out there at ALLVP.
That was TechCrunch doing its things.
I like it. I like it. I do my homework, and I know that. And so at ALLVP, you're a great fund that's leading a lot of early stage stuff. And Kaufman Fellow, been deep in the ecosystem for a long time from Chile. And so it's great to have you on here. As a great investor in the region. And I'll hop to Gabe here at Andreessen. We've got one of the partners there, some operating experience at Oscar Health. Did a little stint as a banker as well. And studied economics and computer science. So it's great to have you on, Gabe. Very active early stage investor in LatAm. And then my good friend Jonathan. It's great to have you here, John. An early mentor at Latitude, supporter since day one, and fantastic operator / investor. And building a new company now. So. Incredible portfolio you have as an angel, and now with Investo in your in the fund that you run. And then our partners at Jeeves, Dileep, what's up, man? How are you?
Good. How's it going?
So good to have you on, man. I'm so glad we can host this and celebrate kind of our partnership together to support all those, unlock a lot of value for those founders in LatAm. So. Your intro is second-time founder, killing it with Jeeves, expanding all over the world pretty much, and a huge focus in LatAm. And we're really excited about our partnership to, try to unlock some of that value for early-stage founders through some creative financing opportunities. And so thank you for being part of this and co-hosting.
Yeah, no, we're looking forward to it and excited for the partnership. I think a lot of the companies that we want to kind of have on the Jeeves platform overlaps very strongly with folks at Latitude. So we're very, very excited for this partnership together.
Cool. Let's kick it off. I'm going to kick it off with I think that Dileep, why don't we just ping pong with this, and we'll just hit up these investors, see what they're made of in terms of demystifying. We got to as a very founder-centric organization at Latitude and Jeeves. I think we both care a lot about founders, and we want this process that shouldn't be as complex as it is. I think so. I'll start off with the first question, and then feel free to just dive in, and we'll kind of ping pong here with some stuff, and then maybe we'll take some time and take some questions from the audience if we have some time here. But let's start with you, Antonia. I think. Listen, there's as a founder who's made my fair share of mistakes over the years in building companies, and particularly on the fundraising process. I remember I got rejected one time by an investor, and I came back and just cut my valuation in half. And I'm like, do you think this, will you take this? Just a very inexperienced way of managing this process. I'm curious to hear from you and get your take. What are the most common mistakes that founders make when navigating the fundraising process for the first time?
Great question, Brian. Thanks. So I think to start with, I think that as investors do due diligence in founders should do diligence on VCs, right? I think that starting there, and as many of you know, as serial entrepreneurs, there are many things that VCs do wrong, and you want them to know in advance. That's on one end. And then on the other end, you want to know that you're the right fit right? You want to know when to reach each investor and make sure that you increase all the chances that you have to have that investor in your cap table if you want to have them in your cap table, right? And then on another side, I think that founders should think very carefully on their cap tables, and all the deals that they accept. And sometimes it could be because they are stressed, they want to get over, the fundraising process fast, the negotiation fast, and they miss certain terms. Don't. Just be very conscious of every term that you're accepting, understand the consequences, understand, their implications. And I think that's also something that as VCs, we like to see. We like to see founders that understand the implications of anything that they are taking on their companies. And then finally, I think that it's time to reflect after the conversations from VCs, right? Usually you can have a conversation with a VC that knows very deeply that industry. Sometimes you can talk with a VC that doesn't know anything about that industry and provides feedback anyways, or provides inputs anyways. So just like reflect on what you're hearing, take what makes sense, and don't take what doesn't make sense, right? So those would be my three things.
No, I love it. And one just kind of quick comment on that due diligence of the investor. One thing that I think founders don't do enough is, first of all, they spend the entire pitching the company, and you should take advantage of that opportunity and ask them questions.
Exactly.
How much dry powder do you have left in your fund? Why is this maybe a good fit for you? And I think that kind of changing that dynamic is something that I think that founders, first-time founders don't usually do, and they kind of just, are selling the whole time. But if you've got a 30-minute conversation with a VC, I think a good 15, 20 minutes of it should be letting them talk and asking questions. But so anyways, I love that kind of due diligence, perspective. I think it's great.
Actually, Brian, it's when a VC start to sell themselves that you know that you're onto something. When they start
Yes.
Yeah. So Dileep, how do we get them there? How do we take us,
Yeah. So I'm actually kind of curious just from the investor perspective. So one of the things that I think, I've heard a lot is that, you need to have kind of a good idea, a good team, but then I see people with good ideas and good teams also not necessarily get funded. So I'm kind of curious, again, since we're trying to demystify the process, right? Like maybe just asking the question, as an investor, like how do you listen to 5-10 pitches and not get jaded and think you're listening to the same? Because everyone does some form of mapping, right? Oh, it's a bank. I know neobanks. Here's like my mental map for that, right? So maybe Jonathan, you can start, but like how do you listen to multiple pitches and still kind of listen to them as real pitches without just like filling in the gaps with kind of your own like information to some extent and like getting jaded to some point? Like I've always been curious how that process happens.
I think that actually there's one step before. When you see a lot of very talented young people working on something, then you kind of understand that something is going on in that space, no? So it starts from there. You start seeing like a lot of very talented founders working on something, and then you try to understand yourself the space. So when you see a lot of founders pitching to something similar, there's always some founder that has more intel or have made more, like they know better the space than others. Actually, when you have the feeling that you know better the space than the founder, there's a problem, no? It's early, or also when they have trouble to explain to you in very simple words what they do, then usually it's also too early. And that's actually what you see. You see a lot of people pitching something too similar with not a big difference, and then suddenly there is one coming and with specific intel, with a different way of approaching the problem, and then usually it's maybe from the outside it seems the same, but actually when you have enough intel, and since you spoke to a lot of founders, you can see the difference. And I think that's usually like a big tell. And I would say that's one, and the other is how did the founder come to you? It can be through other founders, it can be through one of the investor, or even a cold email. I think like
do you actually respond to cold emails? I feel like every investor says that, but never actually responds to it. So curious.
I'm very selective on the cold emails, but I will always respond to a cold email if it's well written. I mean by that is if a founder reach out to me with a generic email, I will never answer to it because we receive too many of those. And it means that they don't really care about talking to me. They will probably send that to 100 and they expect one to answer. But when a founder has a specific reason why they reach out to me and can explain it in a very short and concise email, I will always answer them and always take the call. But in order to do a good cold email, you need to work on it. You need to make you need to know why it would be interesting for me to speak to you. I think the biggest mistake is 90% of founders are reaching to the wrong investors. And that's actually why they have more rejection than they should.
Let's double click on that a little bit. If you're pitching to the, how do you know you're pitching to the wrong investors? How do you identify the right investor for your stage, sector? Like what are some tactical advice that you would advise founders to do in order to prep and make sure they're not just casting out all these messages to or pitching all these investors that are just not a fit at all? So what kind of, there's a phrase that we like to use at Latitude, which one of our mentors, Jason Ye, quoted Abraham Lincoln: if you have 6 hours to chop down a tree, spend the first 5 hours sharpening the axe. So what kind of axe sharpening would you suggest so that you increase your conversion and the potential of getting through to an investor?
I think Antonia mentioned it earlier. I mean, like, it's to know if actually this fund invests in your region, in your industry, in your stage. And I think too many founders just send it they send it to a lot or as many investors they can, expecting a result. And if you know and you can shortlist which are the potential investors that actually will invest in what you are building in your region, in your stage, you increase your potential of having interest from the investors. But I think that's usually because they think that volume will help them, or they believe that will create FOMO, like by talking to a lot of people and then suddenly. But it's like trying to bluff a professional poker player, like if you're not a professional, it's going to be really difficult. I mean, Gabriel does that for a living, like he talks to a lot of young people in Antonia. So it's really difficult to bluff a professional investor.
And to add there, I think that there are some tactical things that founders can do, and of course doing the research and like going into the webpage of the investors is kind of like the first point. But then I think something that it's very tangible and it's out there is the announcement of the investments that the funds have already made, right? So you understand by those investments, what are the stages that the investors invest, what are the sectors that they invest, and you can derive a lot of conclusions from that. That's one thing. Of course, Crunchbase is another one. And then there are some funds that are less open to press releases and all of that. And many times you want those funds in your cap tables because they are very specific to, or very niche investors, and they understand one sector very well. And the best way to understand who are they is to ask other founders, like which investors you have in your cap table. So I think there are some tactical things that you can do in order to improve that research and take that from Crunchbase, the webpage, beyond that, right?
I think one last thing that I just wanted to add this is like, when it comes to fundraising, having structure is very, very important. And I think this is what Brian was saying with that quote, is like sharpening the axe, like practicing. But one of the things that I really think about is the angel network. I think that's one of the things that is the most important across Latin America. Like, I honestly, when I get pinged by like several people that I have in my network recommending a founder, I find the signal to be very, very high. So the way that I think about deals is like signal versus noise. And like, which one should I be paying the most attention and like spending a lot of time? Because even before the meeting, when I got pinged by like 3 people about this person, I'm already like prepared to answer the question on Dileep. Like, this is probably going to be like a great meeting. Like, I need to be my toes and like really prepared and like make sure that I impress the founder ahead of time. And one of the things that I really love about Latitude is that, people that really don't have a network necessarily can join the community. And from there, like start developing and, expanding the network and meeting other people and then get to angels and, and that way. And I think before Latitude and before communities, it was really hard because if I'm from El Salvador, for example, so if I wanted to like fundraise from a VC in Mexico or Brazil or the US, it would be impossible for me to connect. But like now joining this community is actually very important for me because that gives me access to a network and that network has access to another network. And the way that I think about it is, how do I optimize the signal when it comes to a VC that I really like? So I think that that's one of the main things I want to highlight on this.
I'm just going to jump in real quick and make a add on to that a little bit. When I think about getting those kind of angels involved, to kind of help you early on your first, call it pre-seed or whatever, it's good to also map people that might have I put people in a couple different boxes as angels. Like one, maybe they've got deep operating experience in your sector, could be in another market, but they have, they lend credibility because they understand your space. And then another bucket, and it could be the same person, if they have access to stage financing. So kind of complementing what Gabe said, if they have that deep plugged in network and, they can open up, some of those contacts, I think that's something that is quite helpful. I'm going to ask one more question back to Gabe, and then Dileep, you can fire off another question here. Gabe, I'm curious, you work at Andreessen, obviously it's a big global firm, and, I would love to hear from you, besides having those signals that help you kind of identify and cut through the noise, anything you can share with us, if you want to share proprietary stuff, we'd also love that, but anything that you can pull back the curtain a little bit on, the process and, what's the framework look like at Andreessen a little bit, just to kind of help us understand a little bit more about it, as a founder, what is in the psychology, what is in the process, and, what more information can you share about that when you're at the kind of decision table and you're debating different companies?
Yeah, I think, to pull the curtain, we try to be very open about our process. Like, we actually have like a lot of content out there on things that we're looking. But I think when we are looking at a company, the first thing that we analyze is called the idea maze. This is a concept that like a general partner and Andreessen coined. And basically the idea behind it is that imagine that you're about to go through a maze. Like the best founders, they know which turns to the treasure and which ones lead to death. So they already are familiar with the space that they're working on. But most importantly, they also understand the history of the industry. They know the players in the maze, and they know the casualties of the past. So like when I talk to somebody, like the first thing that I assess is like, does this person have encyclopedic knowledge about the industry? Like, do they know what they're talking about? But like to a level that, I recently put this post on LinkedIn called like the team, the look of the dog, which it was basically comparing how Messi looks at the ball. And he never, every time that people kicks Messi off, he's just focused on the ball and gets up and he doesn't care who kicked him. And I think that it's very clear to me when I'm talking to founders, who is that founder that has the entire vision in the ball and like, where does they want to take their company to? So I think that that's the first thing that we focus on. And then why the network is also important and the signals for us is because, I operate at Andreessen Horowitz, but like we don't have offices in Latin America. I travel a lot to the region. But why signals are important is because I need to understand who you are in terms of the context of the ecosystem. Like sometimes when I get pinged by like a unicorn founder about another founder, even if he's very young, I find that to be super impressive because the person to get that level of signal has to go through so many hurdles and in a way impress this person because nobody's going to recommend something that they don't think is exceptional, right? Especially to funds, because it's also a reputational risk that you take. So the fact that they do that is in a way like a double signal for us. So we look at the idea maze, and I think the other thing that Dileep mentioned that I wanted to is like, is this person, because there's people that have amazing teams and amazing product, but actually the thing that we look the most is like, are they solving like a real problem? Is the market there for what they're solving? Because at the end of the day, you can always upgrade the team on the fly if the market is pulling the product out of you. And you can have an amazing team and amazing product, but if the market is not there, you're probably not going to get anywhere, and then you're going to end up pivoting to a different solution and finding a different opportunity. But I think those are the three main things that like we usually tend to focus on when we're evaluating. The other thing too is that we have, and something that a lot of founders have a hard time understanding, is that we can only place one bet in the space. So for me, the opportunity cost is extremely high to take a bet at the seed investment. Like I have to be extremely sure that this is the best team and this is the best approach for us to take an investment, especially at the seed level, because otherwise I can wait to the Series A or the Series B to make the investment and kind of see how the theme plays out. So this is something that Jonathan was talking about. Sometimes right now I'm looking at account-to-account payments in Latin America. That's like a big thesis that I'm looking into. But like I still, doing the research to understand what is the right wedge and what is the way. But if I were to place a bet on one team that got me really, really excited, and then it happens that the solution comes from a different angle, my opportunity cost is like the worst that can happen to me is picking the right category and the wrong horse. So that's why we also like try to analyze a lot about like, is this the right time to invest, and are we sure that this is the leading team to do so? So just a couple of things that we look at.
I think that's actually a really good point, because we did our Series A with A16, but we were actually in touch with them for maybe about a year before that. And one of the key things I think people forget is, with investors, it's always good to say something and then deliver it. And that track record, even if they're not invested in you, goes a long way. And, as someone that has raised a lot of capital very quickly, one of the big things was that it wasn't just like I woke up one day and, someone wrote a check. It's like they had seen the A, they had seen the numbers that I sent out, then they saw the B, they saw the numbers. So it was a track record, right? And then it's like, well, he said it last time, he hit it. He said it again, he hit it. So like the risk is taken off. The de-risking process, I think, is very, very important. But I'm actually kind of curious what metrics, like just to kind of get into the tactical, looks like for a seed and a Series A. I think it's very different now than it used to be before. I think everyone's focused on margin, focused on profitability, but I still see a lot of deals done that don't necessarily have that. So I'm, again, just going into it, like what do you consider like market metrics? Maybe Antonia, you can start there. And also like, what do you need if you don't have that as an exception to the rule to get funded?
Sure. So on our end, what we look for, and of course it depends on the stage, but generally speaking, I think the way that we like defining it is an inflection point, right? So what's the inflection point towards the stage that they are approaching? Understanding that in the pre-seed stage, you're just like validating the idea. So is it an insight? Is it, like something that you are the unique person to build that product and solve that problem? And then in the seed stage, you have some validation, but there are still certain hypotheses that you need to validate, right? And I know it frustrates founders because they usually want to hear a metric, they want to hear a specific number, but like I like to tell it in terms of concepts, right? Because you do have certain things that change, and that's why you're approaching the next stage, and that's why you're requiring this next stage of capital. And it's the same thing for Series A, right? What's the inflection point that actually makes you reach this stage that you're going to use that capital for growth? And that depends on the company. And sometimes it can be, 4 months of sustained growth. Sometimes it can be a year of sustained growth. I really think it depends on the industry, it depends on the model, it depends on many, many things. But we always look for that inflection point, and it ties back to what Gabriel is saying about timing, right? So of course it ties with traction, it ties with the timing of the market and the timing on the founders as well. I don't know if that makes sense.
100%. I think we're in a little bit, we'll dive into some of the questions. We're getting a ton of questions. Maybe we'll take a few more minutes here before we, there's a lot of great questions. And if you're listening and you want to get some questions answered, we'll do our best to try to cover it here in this short amount of time. Maybe we can go over a little bit because of the late start. Yeah, I think, in fact, maybe we can do that now and we're here to answer your questions as a founder, and you don't want to hear us drone on. We're here to answer your questions and create value for you. So let's maybe pull up some of those questions. I'll pull them up, Dileep, if you have any other quick thoughts or questions that you want to ask before we dive into that. But I think we should definitely, see if we can answer some of these questions.
One
Go
thing
there,
that is-
upvote the main questions that you see. If we can drop the Slido link in the chat also.
Just one thing that I want to add, as well as you meet with investors, Dileep actually reminded me of this. It's like sometimes it also requires like building the relationship over time. Like this is like it takes the really long view. It doesn't mean that in the first meeting that you have with an investor, the person has to get to conviction. It's actually it's like any other human interaction. It sometimes takes time to build the trust, and that part is part of the due diligence process, but also like approaching it from like a human perspective and building that relationship over time. Like also can remember about John, when we met, and like I was new to my job, and John was like, like explaining me a lot of different things. And like now, we're partnering so many different initiatives, but like the human aspect is also very, very important, approaching not as a transaction, but as a, as a relationship, because most investors do want to help the ecosystem, and, it's our job to build those relationships as well.
Actually, I have a quote on that, is like expecting to go to a meeting and, getting out with a check. It's almost like going to a bar and getting out married, I know we all have a friend like that, but it's not like the usual thing to do, and not also the best recommendation. Like Antonia said earlier, take time to get to know people. It's easier also to get people to know when you don't raise, so you create a relationship. And then when the time is the correct one, then you will have a network to who you want to pitch, who you don't want to pitch, and people will receive you because you already created a relationship before.
I think one underrated point for a lot of founders is, when you actually go to an investor and you're like, I'm actually not raising right now. They're like, wait, why are you not raising? Like what's happening, right? And that's part of the relationship building. It's like, no, I'm not looking to raise. We're good. And then you build it, and then the crescendo is ready. And then you like drop the hammer. It's like, all right, we're starting, we have 4 weeks and here's the metrics, but you have to be prepared. And so, there is an investment on the time side, but I think it's very powerful when you're also like, I'm not raising right now. And, you can go back in 2 months and we're like, now I am raising. And they're like, okay, like, great. Like now I feel like I've known you for 2-3 months. Like, tell me more about what you're building and the metrics.
100%. Let's jump to the questions so we can start answering all these questions. First question, this is from Anonymous, does it really matter how a company is incorporated when you make a decision to invest? Who wants to take that one?
I mean, I think it really matters, actually, and the reason is not what people think. It's mainly because most of the institutional investor, they know about certain, laws in certain countries, and they don't want to experiment, of what would happen if they invest in a company based in Ecuador, and how they would deal if something goes wrong. So don't try to reinvent the wheel, just do the best practices. Today in Latin America, Cayman is pretty a standard, and the second one is still in the US, and stick to the obvious one.
Yeah, I see a lot of founders trying to get cute and do like, BVI or like, and it's like, no, don't try to innovate on this. Antonia, I'd love to hear from you, and then, Gabe, if you have a quick comment.
Yeah, so what I was going to say is that fortunately today we have more tool and more accelerators that are taking the challenge of educating on that regard. So I think that Latitud Go is a great example of that, and that creates less tension or friction for founders to think through this process, because it really matters, as Jon was saying. So I don't want to repeat that, but I do want to highlight Latitud Go and the amazing impact that it will have in the future exits that we're going to have in the region.
Yeah, you were an investor in Corner Shop, right? And Corner Shop had a Cayman structure, which was a really important, element to their exit.
Yes, indeed.
And I just dropped a note in if there's any Brazilian founders, we've started with Brazil, but hopefully expand for the company formation. In fact, Andreessen's an investor in our company that we got a couple investors in our company on this call, but so thanks for the shout out, Antonia. So let us know if we can help there. Let's move on to the next question. Let's see. Should I reach out to VCs that have invested already in my competitors? Do VCs invest in multiple companies doing similar something similar? Let's hear, I'd love to hear from investors on this one. It's a great question.
So I think it's a great question because most of the time people think that they're competing with somebody and they're really not. So I am of the perspective of that you should like that shouldn't stop you, and especially if it's like a VC that you've done the work. Most of them, like, you know, for us, every time that we meet someone that might be conflicted, we let the founder know. And we actually, what we're trying to do is to understand the angle that you're coming from, because sometimes the spaces are very, very big. And then you can tackle, like, there must be like 2-3 opportunities within the space as well. So like, and especially at the seed stage, like companies pivot all the time. You know, like the main idea that you might have started like might evolve to be something else. And you know what you might have thought to be your competitor at the seed stage might end up being, you know, actually complementary to you. And I've seen that happen a lot of the time. So I actually think that you should 100% do that. There are different type of investors where they gather intelligence and like they give it back to their portfolio companies. But most of the time, like you should act on the assumption that people in the industry are not here to like. It's not because they gather intel on your company that the other company is going to win. You know, it's not because of that. So like, I think the opportunity cost for you not to reach out to an investor because of that is very, very high. I think people should definitely reach out and try to really understand if they're truly competitive.
I would like to add to that actually it's the opposite. Like when you see a fund that actually invests in that space, in that industry, they already have a conviction of that space. So the probability of investing in things similar is higher than a fund that might actually don't like that space or that in the specific industry. And it depends also if it's a fund like ALLVP or A16Z that usually take a higher stake in the company. They will probably not invest in a direct competitor or something that's too similar. But like Gabe said, it's not always what you think is competitors, you know. And I would say like if you go to angel investor, early investor, usually they have less stake in a company, and they will invest more in certain space because they actually can bring value, they can help, and they're obviously interested. And I would say in our case, sometimes when you're already committed to a space, and since you cannot have as much as equity as you wish in certain companies, like Dileep didn't let me invest how much I wanted, then you end up trying to invest in different players in that category, even if they are not like competing directly. And sometimes you even have to invite Dileep to invest in a potential competitor in the future just to be sure that he let me invest in the other company.
Just one thing to add to that was the way that we actually, one of the ways that we define conflict is, are you fighting for the same budget, especially if it's B2B company? Are you fighting for the same budget for the decision maker within the company that you're selling in the same market? So it's like actually like a very, very narrow view of the conflict. And if you're like, let's say a Brazilian, like we invest in a Brazilian player and then you're starting in Mexico, that's not conflict. So like, that's just like wanted to even what John said, like, even if we take higher positions, like, you know, Latin America is so big that you couldn't, you know, unless it's like default LatAm day 0, like it will be very, very hard to not look at those opportunities as well.
I think that's great. And I think there is a distinction between pre-seed and seed. Like you said, Gabe, like sometimes really early companies, like you don't even know what you're building yet, right? And so like, and founders usually obsess and think that they're competing with everyone. And my experience tells me that, you know, things are going to evolve. Who you think you're competing with today will not be you're competing with. And then sometimes, you know, a fund makes an investment and then there's a clash between, you know, and that sometimes happens. So I want to ask Dileep a question here. This next question is a very highly voted question, and it's from Anonymous. So whoever you are, Anonymous, we hear you. And this is a great one because, Dileep, you've been very successful at fundraising. I mean, obviously, you've been a successful operator that has built a lot of value for shareholders, but you've been successful in the fundraising game. When should founders start building a relationship with investors? You know, when should they do that? When should they not do it? How to approach them? I want to hear from the founder perspective for a second.
Yeah, I think you start. So I look at things as a combination of like time and money, right? So in the beginning, when you're starting out, you have a lot of time, you don't have as much money. As you build a company, your time becomes very like tight, and you have more resources, money, right? So in the beginning, you should be meeting with people when you have an idea, because again, you want to meet in a low pressure environment where it doesn't feel like you have to get a check and they feel like they have to or have to not write you a check. And then if they didn't write you a check, now it's weird. Like, it's like, do you talk to them again? Do you not? So I would say as soon as possible. And I would start with your network. To everybody's point here, the best intro is a warm intro, even if it's, you know, just a friend or a founder, or now that, you know, from Latitude's network, but like something that's warm, just to be like, hey, I'm stress testing this idea. I'd love to just get your thoughts on it. And again, like a lot of investors get a lot of these, but investors also use this to find good founders. So it goes both ways of like, okay, what is that person working on? And like, is it something I want to keep tabs on? So we reached out before we even did Y Combinator. First, actually to A16, I had a warm contact there. They said no. We did Y Combinator. They said no again. And then they ended up doing the A. But I think that historical thing really, really helps. And like when we first reached out, there was nothing. It was just kind of like this concept of like a global business bank. And some funds need more metrics in the beginning. Some funds don't. And I think to Jonathan's point, like even today, we have probably 60 people in the cap table, and our seed investors are some of the most, you know, valuable people that I turn to even today, and ping them directly and be like, hey, like I have this thing, what do you think about it? So, you know, just to answer the question, I think as early as possible, even if it's an idea stage, and you don't have to take like an hour of someone's time. But I think just planting that seed is very, very useful, because then you get to water it later. And, you know, that's like the fruit comes later, but you have to plant the seed first and go through your network as much as possible. There's nothing like a warm intro. I mean, I get intros now even for like seed investments, and it still comes down to like, what did that intro come from? Because I don't have time to evaluate it, because I'm running a business as well. But I think investors also value the fact that it comes through a warm network, except for Jonathan. All cold emails go to Jonathan, because he's very open to cold emails.
I think there's great opportunities, and a well-crafted message. Actually, you know, I think that is something. Actually, ALLVP, I remember going back and forth with Fede, your partner at ALLVP, on like, do you guys actually respond to cold emails? He's like, yes, we do, and we think it's a well-crafted email. And I think to your point, Dileep, about building a relationship, you know, I think things got a little too transactional in 2021 and 2020, early 2022, where it was like, oh, popping into the investor. We got all these, you know, and it was like just the FOMO machine. Listen, FOMO does work, but you need to know how to, like, you know, do it. And the reality is, you know, I wrote an extensive post when we raised our seed round about also choosing your investor. This is a long-term relationship. Like you do not want to just work with someone just because, and you want to find out what it's like to, you know, that they're going to be partners. You want people, you know, work with people that believe in you and what you're doing, and are going to do the thick and the.
Just one point on that, when we were deciding for the A, one thing I thought that was really useful is I asked investors to put me in touch with deals that didn't work out, that were bad deals. And good investors will still get references from those deals. It wasn't that they did the next round. It was like, what was that relationship when the deal failed, when you actually need someone, right? Because when you're booming, everybody wants to give you money. It's the other side when it's not going good, when you actually have to go, you know, into the trenches, like what's the relationship? Were they reachable? Did they pick up the call? Did they try to go to bat for you? Did they not? And founders, again, like I think provide the best reference, but ask your investors that directly. Like, what happens when the deal goes south? Can you put me in touch with someone where it didn't work out, and have that conversation with them? And good investors have those references as well.
I actually asked Angela that question when I was pitching her, and actually, for the fun fact, the three of us, Brian, Dileep, and I, we raised from Angela, and she answered me something very interesting. She said like she makes her money off the company that obviously are doing well, but her reputation on the one that doesn't. And I think I really enjoy that say, or that quote, because and honestly, I also know some of the deals that didn't work as expected, because I also invested in some of those, and I know the founders, and I've seen, you know, in that case, Angela, you know, behaving the right way. And I think that's to your point. Try to find out like what's happening with a partner when things are not going as expected, and take that into consideration, because we don't have to forget that we are doing something that's highly probable that will not go as expected, and focus on that.
I think that that's something that founders should ask way more. We don't hear that enough, you know, and I completely agree with that phrase. It's actually a phrase that we like using in our office as well, and we like, you know, making sure we're there for the bad cases as well that we all have, right? And we want to be there for the entrepreneurs at that time. But I think it's good to hear that Anderson Horowitz does that, because usually we've seen US funds be more practical in that sense, you know, very
I actually think this is a good
To
point.
give
which
credit,
is,
it's actually Ben Horowitz's phrase. Just want to clarify that.
but I think one thing also founders should do is figure out which partner you want to work with. Like when we had our Series B, I specifically asked for a partner. Again, like this is all problems you can do sometimes, and sometimes you can't. When we did our seed round, it was a large party round, and I needed money to get going, and that was all it was like focused on. So like some things you can do and some things you can't. Like figure out where you are. But I also think a big part is figuring out which partner you're aligning with, because someone that's done a lot of deals, a lot of successes might not have the same, kind of velocity as someone that's just starting their career, et cetera, because they're also going through their, startup journey just as at a fund.
I think it's a great point. You're not choosing just a firm. You're choosing the partner is actually sometimes more important.
I think more important. I agree.
Way more important the partner than the firm.
Yeah.
And take into consideration that it's way easier to get divorced than separate from one of your investors. So if you take that into consideration, choose wisely.
I want to talk about this notion of failure and that things don't always work out, and the trouble with that. One thing I see founders a lot of times optimizing in their communication to investors, trying to remove the doubt of like it's gonna work, instead of reducing down to like, oh, there's a low probability we're gonna fail. Like that is, you want to take the inverse of that. You're like, listen, there's a good chance this thing doesn't work out, but if we get it right, we're going to transform an industry. And I think that narrative is like, first time founders are like, they're really conservative with how they communicate things, and I think that's something that is a turnoff for investors, at least from what I've seen, because the concept of a fund returner, if you're not familiar with that concept, is it's one investment pays for an entire fund. And so, that is the dynamics of VC. So I just think that on the failure side, instead of trying to minimize the risk involved, don't try to, obsess about that. This isn't like late stage private equity. This is venture. You should, communicate a large vision that you're going to be able to. You want to jump in the next, Dileep, and grab that next question in front, and the one that's been uploaded. Go for it.
So the question is also from Anonymous. How do I approach fundraising in an industry where there's little to no investment record in locally? Aviation, for example. Should I raise outside of LatAm, for example? So I don't know who wants to take that that specific question, but it's actually, I think, comes back to like the question of whether you have theses specifically at firms. But maybe Gabe, do you want to kind of take a shot at that, and we can broaden it?
Yeah. I think my partner Alex Rampel has a really good concept about this. So he calls it like a 2x2 matrix. So he says there's like consensus, non-consensus, right and wrong. So he says to make money in hedge funds, you actually have to be non-consensus right, because otherwise you're not beating the market. But in VC, what happens is that to make money, in his opinion, and I had this debate with several investors, but it's like you have to be consensus right. And what that means is that because in VC, like you also depend on downstream capital to be available for your investment. So it has to be, I understand that there's a lot of founders right now, especially I've seen in the climate tech space, where it's actually not as developed in Latin America, and I think it should be. But one of the things is that one of the risks that the investors takes is like, it's not only the idea good, but is someone else going to be able to put more money into this idea later on? And unfortunately, if the thesis is non-consensus in that sense, it doesn't mean that VCs are very open-minded. When we invest, it's like, like for example, the investment in Latitud, right? It's like a bet into the community, and into, you have to be visionary just by default by being a VC investor. But sometimes there's, pitches about things about climate tech, for example, that might not be the right environment yet, or like you don't see certain signals, and then you're worried that there's not a lot of downstream capital. So I think that when it comes to that, I think that people have to be actually a little bit more patient than in other industries. And you have to diversify even more your network. And one thing that I've seen is that in those specific markets, you have to target investors that are specialized on that specific topic. So for example, aviation. I'm pretty sure that there's VCs that have done a lot of aviation. There's VCs that have done only insurance, for example, which is like a very capital intensive model. And you have to be even more targeted when it comes to those. And that's a way that I've seen people solve that, especially like the A to B type of rounds, which are the hardest in this type of non-consensus. And then when things start working, then it's just an assessment of the financial model and like the margins and there's actually a business behind it. But to get started, you have to be very specialized and even do even further research. And that'll be my advice to that.
I think that's a great point. I think that there are certain industries that are very specific and it's hard to build the expertise around that industry. And you need to understand the deep components on it, especially when it's like too technical, like deep tech or biotech or something. So you may want to go out and look for external capital outside the region. But then there is the market component to it, right? Like the VC market is not perfect. There are certain companies that are ahead of the VC investment, for so to say, and then you need to find a way to move around that stage. But then eventually it needs to come, and then make sure there is a large enough market that VC care, right? Because it won't be a problem on only LatAm, but it will be a problem on US or Europe or etc. Right? So I think that it's important to understand. It's hard to generalize, more to say.
Yep, that makes sense.
We've got a question from a Latituder here, Alexander. Great to see you here. Thanks for your question. So David, parentheses, Nubank, set the gold standard with this culture deck. Yet so many founders spend so little time focusing on building their own before hiring. Why is this? Dileep, do you want to take? You want me to jump in and give you my?
I can give my thoughts. So one thing is, I think culture is a living, breathing thing. I mean, we are a 200-person company now. We obviously didn't have 200 people when we started, and you have culture, but culture is what you do every day. So if you just have something you write in a document and you don't actually live it, or it isn't part of your process, or how you interview people, like just kind of the values and things that you just resonate, I think it's a lot of hypocrisy. So the writing part, completely agree, and you should do that as the founder, and no one else can do it except for you. It's not your HR person, it's not the people team, it's you. You're the founder, like that's your job. But the second part is also really important, which is like, do you live your actual culture? Like, is it something that just comes out of you? You're customer centric, but you don't respond to customer emails. You're not customer centric. Like, it doesn't matter what you actually put in writing on that paper, and then it actually starts sounding false, because it's like, oh, if you don't value that, then what do you actually value, right? And so I 100% agree on the first step, and I think it's really important. We did that at Jeeves as well. But I think the second part is also really, really important, which is like, are you living that? Is it like core to who you are? Like, one of our things is being relentless, right? Like, we just want to move quicker, faster, as fast as possible. Like, does that show in what you do? Like, is that the reason you expand? Like, what is it that like you're doing that like gives that meaning? I think that second part is really, really important. But yeah, I that's just kind of my thought there. Curious, Brian, on your perspective.
I dropped a link in the chat to What You Do Is Who You Are. It's a book by Ben Horowitz, one of the founders of Andreessen, and I think it's the best culture book that I've read for startups. And as a second-time founder, echoing something you said, and I'll be more explicit about this. Values. Everyone talks about values, and that's great, but values can sit on the wall, and if you're not living them, they don't matter. So Ben in the book talks about virtues. Virtues are lived behaviors. So just echoing what Dileep said and kind of synthesizing that a little bit more. Latitude, I've got the benefit of having built a company before where I think we had a good culture, but it was not designed. Like, it was not something that we were very like intentional about. And it was just kind of like, it just happened. And so, Alexander, I think that the reason why people don't do it, probably they just don't see the value. It's something that they haven't been through the process before. But when we started Latitude, we spent a lot of time on this. One thing that we did at Latitude was, instead of defining all this stuff from the very beginning, the founding team, the first kind of 6, 7, 8 people, which really set a lot of the DNA, we operated for 8 months. And then we actually took inventory of the things that we cared about as we operated. So we kind of, imagined, if I were to start Latitude on Mars, what are the qualities that who would I want to take with me? And I was like, oh, I take Jan because, he's so customer focused. And then we basically distilled them down into a kind of a balsamic reduction sauce of qualities. And then we kind of translated that into our virtues and, their lived behaviors. So I think that, it's hard to have a position on this if you're just starting. I remember when I first started my first company, I literally went to my former employer that had a good culture and I copied their values, because I didn't know what I stood for. And so after 20 years of, being in the trenches and getting beat up a bunch, now I understand what we want and what we care about. And those are exuded to everyone throughout the entire organization. And we also build in public. And so we externalize a lot of this stuff, which is a very effective way of attracting people because there's a self-selection process. So that's at least my take at Latitude, and we deeply care about this in our company.
I would add one thing, that actually it's a paradox, because the faster you grow, the worse it is for the culture. So on one hand, you want to grow fast, but it's like diluting. Like you have a good wine and you put more water inside, and then it changed the taste and the color and everything. So on one hand, you want to grow slow to keep and have a strong culture. On the other hand, investor wants you to grow fast. And obviously everybody thinks about startup going fast, and one goes against the other. Especially because what you actually write down doesn't actually apply on the day-to-day of what you're building. And we suffer from that at Green. Like it was something that really affected us as a company, growing fast, and it was really difficult to actually create the environment that you actually, like what Dileep said earlier, that you actually apply your culture to the day-to-day. And it's really hard because it's in the small things and things that even doesn't look obvious. I love that quote. I love that page Quora, where you can ask a lot of questions. And somebody asked, Microsoft is so big, so rich. Why don't they give breakfast and dinner to all the employees like Google? It makes sense. They have money, it's better. And they say because it goes against our culture. Our culture is about family. And if we push people to come work earlier and get out later, it will actually draw them away from their family. So they actually don't do it because they want people to have breakfast with the family and dinner with the family. And it's those small things that seems like super obvious, like just give food to everyone. It's going to attract more people to work. If it goes against your culture, be careful.
Do you want to take the next one? Let's see. So if a fund passed on investing, we're very early on my idea, what's a good way to approach them again for the next round? I can give one thought here because we have done this. So one of the things that's just very tactical is to keep a list of investors that you'd like in the next round. Every round that we've done, we have one form of an investor that would do the next round. And they then see your growth and they can write a check for the next round. Now, if they pass on completely, I have a separate list, which is investors that pass, and I send them updates maybe once every 6 months. Now, not as much because it's different, but like 6 months saying, hey, here's just metrics, just keeping people in touch. I used to call it Friends of Jeeves, and just send that out. And that would just start the floodgates for the next round of funding. So again, it dilutes at some point if you do it a lot, is my opinion. Some people like doing it very consistently. And I think in the beginning, that makes a lot of sense. But I think there's also the value of that gap. And then coming back in 3 months or 6 months to be like, hey, Friends of Jeeves, just providing an update. And every investor will love to get your update, because worst case, they just get information on the market, and that's great for them. So no one's going to say no to your update. But also that's what I use to then kickstart the next fundraising cycle. But curious to get investor thoughts on the other side of this.
Yeah, I agree on that. I think that the gap in between the timings creates a certain momentum. When you expect that update every month, there is no curiosity that it's building up, right? And then the other thing I would add to that dimension is the fact that investors, we talk a lot, right? So when you have a company that for some reason it may not be a fit for your fund, you can be talking to an investor friend and you can mention that company, and that company is going to be, top of mind for that investor as well. right? So it's way easier when you have that company top of mind because they've reached to you. I wouldn't say several times because that's an objective measure, right? But something that makes sense. I think that you're creating a good momentum, not only for that VC to invest, but increasing the chances if that VC is well connected.
Yeah, I would just add that at the end, as an investor, you want to take a decision on a movie, not on a picture. So if you just go and show something, it's like watching one picture. And if you can have more reports and you can have more discussion with the founder, it's like creating your own movie of how it started, how it's going. And you can actually also, the best thing that can happen is when you talk to a founder, he tells you something and then 3 months later it's done, you know? So it's not only words, it's actually they show the capacity of execution. And that's that's the best you can find with a founder. And show them the picture, show them the movie, not the picture.
Yeah, the movie, this reminds me of my fundraising back in my last company. And I remember there was this one investor that was always, they were like a growth investor and they were kind of hanging around. We were too early for them. But I remember I would meet with them once a year and I would literally, tell them what I was going to do the next year. And I would write down what I told them. And then I would meet with them the next year and I would say, go to your notes. And why don't you read me what you wrote down last time? And then I would show that with the progress. And it was like an amazingly powerful thing because I remembered exactly what I told them we were going to do. And then I got to, they had it written down and eventually it was this, as a founder, you need to appear to be inevitable. And if you're inevitable and you're kind of, doing what you say and you're definitely going to be an attractive target for a founder. You're going to keep building credibility. I love that movie analogy rather than a picture because it kind of unfolds the story and you've got to really control that narrative as a founder. Let's take 2 more questions here. And so we'll take Federico's question here. How can we push to obtain real feedback after initial conversations with VCs and angels? In our experience, some of them keep comments to themselves. This is a great question. I would say times 5 in LatAm from my experience. It's a little hard to get it out sometimes, particularly with less sophisticated investors or angels where they don't want to hurt your feelings. I think if you compare this 10 years ago, we've come a long way with the ecosystem in Latin America. So I think that it's, I will hold my thoughts for a second on this and resist the temptation. Would love to hear, what are your general practices, Antonia, John, Gabe, how candid are you with founders? And what, how do those conversations go and how can founders get really candid feedback?
Yeah, I think that's a great question. And that's a question that many founders should be asking themselves, right? How can you get more insights from VCs? In ALLVP, we try to be as candid as we can, understanding that there is a delicate line between, us knowing everything about an industry and explaining just what's our take in it, right? That's why we like talking about conviction levels, in a certain industry. And that's why we like explaining that it's our opinion and our way of seeing things instead of saying that it's a fact in the industry. I think that you always need to appreciate the fact that founders see something in that space or something in that problem, and probably, it can be right, it can be not right, doesn't matter, but it's their take on it. So I think also VC needs to have that line very conscious, and we try to do that. I like when founders ask. I think that there are many founders that ask directly, like, can you provide more feedback? And they need to be open to listening. Sometimes, founders just don't want to hear. And that means that we rather not say completely, like all the different feedbacks that we may have. So we try to provide a certain level of insight, but usually it's founders that do the double click in asking, can you provide more free feedback on this? And that's when we understand, oh, they are open to hearing what we think about this, right?
Yep. Just one thought on that. I think just as you take the feedback, doesn't mean you have to change your entire company, because I think a lot of people take the feedback as like, that means I'm going to get funded. Like, it's at the end of the day, it's your company. like sink or swim, it's yours. Like you make that call. And I've been on both sides of this where they say something, you do it completely different, and they're like, wow, you're such a visionary. I'm like, you literally told me not to do that. So take it as a grain of salt. That's their job. You have your own job to do, and that's your decision to make.
I agree with Dileep, and I would say that 90%, and sorry, Antonia, but 90% in Gabe of what an investor will tell you is just an excuse. Like investor don't spend that much time of telling you why, and obviously they probably also mistaken, because like the thing about VC is you just need to be right once a few times, and you make the number work. Like it's about the outliner, like Brian said, and it's very tough to give straight like a really good reason, and most of the time founders will actually take it badly. So it's a very difficult position, because if you want to be honest with the founder, they will take it badly, and at the end, most of the time, it's just an excuse to say no. I think if you spend really time and you ask and you show that you will not take it the wrong way, you can actually get some really good feedback from investor. But you need to show that you are actually truly and sincerely interested in the opinion, and some of that feedback can actually be amazing. But that's, I would say, probably in my experience, 5% of the founders that are actually really interested in my opinion. Not the 95%, they just want an answer yes or no, and no matter what you say, they will continue. So if you can show investor that you really want their opinion, you will get it.
Let me double click on this one before Gabe jumps in. On the angel side, having done close to 100 investments as an angel, I think that this is one of those opportunities. Someone posted this, that there's a book that mentions this. This is common knowledge and common wisdom about asking for advice. If you want money, ask for advice. If you want advice, ask for money. Actually, I wrote that in my book, but it's not my original thought. But so the truth there is that you're building a relationship with angels. That's such a fundamental thing. And I know that when I'm talking to a founder and they're engaging me in the thought process, all of a sudden I'm giving feedback, ideas. Of course, I don't know their business as well as they do, but as soon as I share in my thoughts, all of a sudden it becomes kind of my idea too. And it's like, I might be investing in what in an opportunity I see. Of course, you don't want to manipulate and be like, oh yeah, and change the focus just because the investor is, Dileep said. But the reality is that to get people excited about it, especially an angel, I think people treat it too transactional. Like you said, John, it's like a yes or a no. And it's building, kind of that having a thought partner and treating the relationship with an angel as a thought partner is way more, it's literally 10 times more effective. And you're also building a relationship. And the second thing I'll say, and this applies to funds, is don't get defensive. I know that you're betting your life on this, and you're so adamant about what you're building, but literally stay curious. Oh, really? Why do you think that's going to be difficult? The go-to-market strategy that we've lined out, because the more questions you ask, the more you can dissect the thinking of the investor, and then you can be armed with ways to kind of present differently. You may just be not communicating clearly. And then you're able to kind of understand the psychology and the thought process. And then for the next pitch, a lot of times the concerns are across the board from different investors, and then you can approach it in a different way.
Yeah, I think just to add on that front, I think Dileep said it, and I really like this. Even the best investor, he's not God. So it's just like an opinion of 7 billion opinions in the world. He might have access to information and have a view of how the market will evolve. But John also said it, most often investors are wrong than right. And when we do our pass notes, that's something that we highlight all the time. We passed on companies like Airbnb, Opendoor, the first time around that we saw them, and then even Jeeves, for example. So most often we are investors are, it's just an opinion. And the second that I wanted to highlight on this, and this is the spicy take, is also cultural a lot. I see that, I'll give you an example of what the bar is for me. I think Colombian founders are very good at taking feedback. And with them, I'm very, very direct because they have this mentality of like, okay, just give it to me. Like I can handle the bullshit, like go for it. Other countries, I would say, like including El Salvador, like we have this mentality where it's very hard for us to say no. So we're like, oh yeah, like, you know, like it's very hard some cultures to say no. And some cultures, like, you know, I'll say this, in Brazil, for example, people are very indirect. Like if you're direct with them, they think you're being aggressive. So like it also depends on how open can people be and on the discussion and on the feedback. So like sometimes you're being direct and then you offend people and therefore you learn and you're like, okay, I don't want to offend you next time. So I think there's some cultural nuances in Latin America depending on the country.
Well, thank you for the spicy take, John. Before we're going to wrap up here because we were going to last comments. Go ahead. If anyone wants to make any last jump in.
Something that sometimes investor will actually provoke you a little bit to see how you react, because at the end you need to be able to work with someone and to see how they take the feedback. It's really hard to work with someone that you cannot work with or that would take everything personally. So bear into consideration that it's part of the process. You're being like tested.
Antonia, estás en México, donde el picante is king. So any spicy thing to end this with, or any reflections or comments just to bring it home here?
Awesome. I think that the last conversation that we've been having the last 5 minutes, it's a conversation that founders should stay with, right? They treat VCs or they think VCs know everything. We don't. And most of the times we're wrong, right? And it's just the math of it. So take things with a grain of salt. I think it was Dileep or Gabe that said it. Take with a grain of salt, take your own conclusions from the conversations and think for yourself on that feedback and what everyone is saying. You're going to receive inputs and suggestions from everyone. Everyone thinks that they have an opinion and they all think that they have it right. So make your own. I think that's a great way of ending, this great conversation.
I love it. And there's a great comment from Gabriel Zamora about this book. It's called The Culture Map. And actually, Gabe, it highlights a lot of these cultural differences. In fact, I read that book. It's super useful. It has like the whole spectrum of like directness and how to give feedback, and it has like all the cultures. And it's actually a funny story. When I was in first moved to Latin America, my experience has been, and there's another book called it's by Felipe Corsini. It's about marketing to Latin American, US Latinos actually. And there's a concept in the book that talks about the directness of communication. And if you think about things, of course I'm generalizing, but when you ask a question, think of like in the US, like an upright triangle. Oh, what's your favorite color? My favorite color is green. And then you give a description of a rationale. In Latin America, one of the challenges that I found being an American is that depending on the culture, you may ask a question and it's actually very thoughtful. You give the rationale first of why you think what you think, and then you come to the conclusion at the end. So it's a very rational way to do it. But for an American, it feels like you're avoiding the question. And so these are some interesting cultural elements that if you're pitching a US investor, you might want to be just more direct. We could probably host a whole session on culture. Latin America is such an interesting, region with, but I want to wrap up here. And first of all, thank our distinguished guests, investors, founders, supporters, Antonia at ALLVP, Gabe at Andreessen, and Jonathan at Investo. I think I speak for Dileep, my co-host here, and I want to hear from him because Jeeves is doing some amazing work for founders and supporting founders. And so I think if you're not a Jeeves customer already, you should definitely check it out. They've got credit cards. I'm a customer. The virtual card is a game changer, and you've got a handful of other products. And so thank you, Dileep, for co-hosting.
Yeah, of course. Yeah, and we're looking forward to the partnership, and feel free to kind of check us out, and we'll have some specials that we're kind of going to have for Latitude companies as well. But You can drop a note to Greg at tryjeeves.com or just go to the website or he would drop me a note. But yeah, we are looking forward to building out this partnership. And I'm very excited about the region. We have expanded to many countries, but our first and every new product we test out still like starts in Mexico. So, you know, it has that engine that we see in a lot of countries outside. So it's just such a core part of, I think, the story of the next 5-10 years.
Awesome. And we're excited to, you know, have you as partners at Vamos LatAm Summit in September 28th in Brazil, 29th. We'll be announcing more details shortly on that, where you guys are founding sponsors and great supporters of that. And of course, if you're a founder in Brazil, if you're still hanging in there, I see Julio, one of our customers actually, who in Latitude Go just said he's looking forward to learning more about Jeeves. He's a Latitude Go customer. So if you're Brazilian and you're looking for company formation so that you can take some money from any of these 3 investors, they'd be happy to invest in that structure because it's the preferred structure. We would love to help you out. So just reach out to me on Twitter or our team at go.latitud.com, and we're here to help. So thanks so much, everybody. Thanks for hanging in with us in the beginning. Well, it took us a while to get started, but hopefully it was worth the wait.
Thank you, guys. Thanks, everyone.
Guys, bye.
Yes, obrigado. Vamos LatAm.
Obrigado. Vamos LatAm.
Yeah.
Ciao.